You get paid, you allocate your grocery budget, and almost instantly, that money evaporates. You're buying the exact same items you bought 6 months ago, but somehow your cart is lighter and your receipt is longer. The math in your head is accurate. The Bangko Sentral ng Pilipinas recently confirmed the pressure we're all feeling at the checkout counter, projecting that inflation for April 2026 will hit a 3-year high. The government usually aims for a 2 to 4% inflation window. April's numbers are expected to break past that threshold significantly, surging into a range of 5.6 to 6.4%. This represents a macroeconomic boodle, a quiet systemic drain that erodes the purchasing power of every peso you earn, while the cost of basic survival climbs. Acknowledging this wealth drain is the necessary first step. Once you see the math for what it is, you can move past the immediate stress of rising prices and start deploying a stoic strategy to protect your capital. Solving the inflation problem requires tracing the pipeline backward. The current price spike originates thousands of miles away, fueled by escalating military conflict in Iran. The Philippine economy is uniquely vulnerable to these disruptions because it imports nearly all of its crude oil directly from the Middle East. When shipping routes in that region are threatened, the cost of moving goods across the ocean reacts instantly. The domestic logistics feel this impact immediately. In March, transportation inflation reached 9.9%, with diesel and gasoline recording their largest price jumps in nearly 4 years. Those fuel costs transferred directly to the consumer. When it becomes 10% more expensive to transport goods from the province to the city, vendors must raise the price of rice, meat, and fish just to maintain their margins. Geopolitical instability in the Middle East functions as a direct tax on the Filipino dinner table, dictating local prices through a global energy chain. The central bank is monitoring these upside price pressures closely. To slow this acceleration, the BSP recently raised its benchmark interest rate for the first time in over 2 years. However, currency depreciation is complicating the defense. The Philippine peso recently hit a record low of 61.75 kosei against the US dollar, making every barrel of imported oil even more expensive to acquire. This combination of a weak peso and high inflation triggered a sell-off in local stocks. The PSEi dropped 1.25% to close at 5,833, marking its lowest finish in 5 months. During these downturns, amateur investors often succumb to panic. They see red on their screens and sell their holdings at a loss, reacting to the headlines rather than the underlying value of their assets. A disciplined investor views this 5-month low as a window of opportunity. They use this macro-driven volatility to identify strong companies that are temporarily trading below their intrinsic value. Navigating this economic cycle requires a framework we call the Alpha Protocol. It is a method for managing capital based on data, not anxiety. The first step is detaching from market noise. Constantly monitoring fluctuating indexes during high inflation periods leads to impulsive decisions, compromising long-term goals. This brings us to the staging ground. Instead of leaving funds in traditional accounts losing value to inflation, move capital into high-yield digital spaces. Earning consistent interest provides a psychological buffer, allowing you to wait out market volatility. Maintaining a liquid position provides tactical agility. It ensures you have the capital necessary to execute a calculated entry once the market stabilizes. Action begins when the market volatility subsides and clear pricing emerges from the noise. This is when you deploy the capital you've been staging. The Alpha Protocol prioritizes established, heavyweight corporate dividend stocks. We look for companies with essential services and massive scale. These established pillars offer a contrast to speculative, high-growth stocks that often lack consistent cash flow during an economic downturn. You want assets backed by decades of infrastructure and recurring revenue. The objective is to secure quiet, consistent dividend yields. By focusing on quality, you can build a portfolio that aims to mathematically outpace the 6.4% inflation rate. Global disruptions are inevitable, but your reaction to them is a choice. Subscribe to master the emotionless portfolio and learn how to navigate the next phase of the 2026 economy.